She's been a longtime bull on growth names, loading up on shares of beaten down pandemic darlings while the rest of Wall Street contemplates their prospects. And the earnings season so far has been punishing to some of her biggest holdings, like Roku today, down 23%. Joining us now, ARK Invest, Cathie Wood. Cathie, thank you so much for spending your time with us on a Friday evening. Now, is there anything so far in the earnings season or the economic data, anything else that would make you waver in your conviction of the growth trade?
Well, what we do see in these earnings results is that we are in a recession. And we've been calling for a recession for quite some time, a lot of it based on excess inventory. So we think this is an inventory-led recession. And I think that's coming through loud and clear. We're seeing advertisers cut back dramatically. It seems like when Walmart and Target announced in May that they were loaded up with inventories, and this was far above what they had expected, and that they were going to have to do something about it. You know, a lot of advertisers started cutting back, cutting budgets, saying, okay, this is a possible recession indicator. And as you know, we've just gotten 2 quarters, consecutive quarters of negative real GDP growth, but a lot of people still are fighting the notion that we're in a recession.
Yeah, certain people are fighting that notion. A lot of economists like yourself, there is a technical recession. But then there's also what a lot of folks, including Fed Chair Jay Powell, says isn't necessarily recession. They define it as a broad-based slowdown across a number of industries. Are you seeing that?
Yeah, I think this is a recession. And I think what the Fed is really focused on is employment as a gauge. Employment is a lagging indicator. The CPI, the PPI, all of those are lagging indicators. If you look at initial unemployment insurance claims, they're up 50% from the low. So I do believe we're going to see some significant disappointment in the employment numbers moving ahead. And I also think, based on what we're seeing from gold, the gold price actually peaked in August of 2020. Many people don't know that. And it's down near the low end of a range, a 2-year range. That's an important inflation gauge. And then copper price. The copper price broke down. It broke a 1-year trading range in the $4 to $5 per pound range. And it has come down hard. So I think all of these are signals that that inflation is going to come down. It's going to come down significantly, and that we're probably going to see some deflation. And we've been calling for that for quite some time as well.
Right. I know you have. And how do you position your portfolio in a recession? What has changed about the way that you're looking at growth stocks?
Well, typically growth stocks will outperform as we move towards the end of a bear market and an end of a recession, because they're the new leadership. As inflation and interest rates were going up, we were facing incredible headwinds. That started in February of 21. And it looks like, at least so far, that we bottomed on an intraday basis based on our flagship strategy on May 12th. And we actually bottomed before the NASDAQ and the S&P did. The S&P broke down to new lows after that. So that was an early signal that we might be turning the corner here. But I think to really turn the corner, the Fed does need to change its spots. It's getting all kinds of signals that it should, like an inverted yield curve. And yet I think it's paying attention to lagging indicators of inflation, determined not to be blamed for letting the genie out of the bottle and causing another 70s-like inflation period.